Welcome everyone. Welcome. I want to welcome you to Legit Crypto and Forex, and I want to teach you something very strategic and very important. Now, you don't have to skip any part of this video for no reason. Why? Because it's going to be a very interesting moment. Quite, it might be long, but I assure you it will worth it. I assure you it will worth it. This is a combined knowledge put together, 8 years of experience put together, and I have actually combined it into like a book where I will be teaching. I'll be using to teach it. That means you don't need to skip any part of this video. You don't need to skip any part of this video. Now, I will be teaching on the basics to advance of liquidity trading. The basics to advance of liquidity trading. I will be teaching you from the basic aspect to the advanced aspect of liquidity trading. Now, in forex, we have what we call liquidity, and liquidity is one of the major way for us to make profit in the forex market. Now, you need to follow me gradually. It's going to be both theoretical and practical. I'll be taking you on a journey, step by step journey, so that you will be able to understand what liquidity is. What liquidity is. Now, before I start this journey with us, I want us to please, sorry for such distraction. Now, let's move on. Kindly watch the end so you'll be able to understand fully what I'm teaching. And before we move deep into this, if you have not subscribed to this channel, do well to subscribe to this channel and click the notification bell so that you'll be notified whenever I upload a video such as this, because I'm really taking my time these days to train deeply on forex and crypto. So I teach people very deep things because my experience, my wealth of experience cannot go in vain, and I'm doing this for free. I'm doing this for free. It's just for you to have your time to watch and learn what it is, and then you make profit from the market. That is just it. Many people that don't have time to watch are people that actually gamble and waste their time. Later on, they will start saying that forex is not profitable. Why? Because they have not learned. Now, I advise you, um, just sit tight and let me take you into this journey. And I want to appreciate our new users and also our returning users. Don't forget to drop for us comment, likes in the comment section, and also a thumbs up in the likes button. Thank you so much. Yeah, so let's move quickly. Now, this is the material I'll be using. This is my very material. This is my very material that I have on forex liquidity training from basics to advanced, and I'll be using it. I might not go through it bit by bit because of our time, but if you want the book, I can send the book to you. Actually, I can send the book to you. You just chat me up on the comment section and I'll drop the book for you. Now, you see, it is actually more of theoretical. That is why I'm doing a video, because I'll be mixing it with the practical aspect. So just follow me. Now, liquidity. When we talk about liquidity, we talk about the measures, the ability to execute trade quickly at stable price. Now, we all know that price in the forex market is highly unstable. So liquidity talks about the measures at which we could actually execute trade quickly. Now, it has to be trade that does not take time to be executed. It does not take time to be executed. Now, this is how easily a currency which we all know, we're talking about currency pair, can be bought or sold without causing significant price fluctuation, that movement in the market. Now, high liquidity means tight spread. We mean the distance between the bid and the ask is actually the spread. Now the distance between it is very tight. Now this happened because of high trading volume. Now the liquidity that we're talking about usually happen because of high trading volume. Now there are pairs that are not liquid pairs. There are pairs that are not liquid pairs. They don't have high trading volume. They don't have high trading volume. If their pairs, their spread is not tight. Their spread is not tight. Now look at this is USD CHF. Look at the spread. You discover the spread is somehow tight a little bit. Look at, is somehow tied a little bit. Now if you look at that of Euro USD, eventually I off my data because I don't want calls distraction, but no problem, let me just on it. Now look at it. Because of high trading volume, you see very tight spread. You see very tight spread. But if we look at pairs that are not major pairs, they are exotic pairs, you discover that those kind of pairs have wide spread. Now those kind of pairs are not liquid at all. Now exotic pairs can be called they can be called minor pairs. Now I'm looking, now all of these are actually minor pairs. They are actually minor pairs. Now let me add them. I think they have been added. Now let me show us the difference. Now look at the bid and the ask of this. You will now understand what I mean. Look at the distance, the spread. Look at the spread. Look at the spread, very big. That's the red line and the green line, very big. Now these pairs are not what, they are not liquid. They are not liquid. Look at this one. Look at this one. They are not liquid. USD NOK. This one is not a liquid pair. Now AUD chaff. Look at it. The pair, the spread also is what, is not tight. But look at Euro JPY. You discover that we have tight spread. Now this one is not as tight as even the Euro USD. Euro USD, USD card. This one is GBP USD. You see the spread, and look at how tight Euro USD pair is. That is why I love liquidity. You need to understand liquidity. Now this is Euro USD. Look at how tight it is, very tight. Now mind you, this is I'm doing this video in the evening time, so even the Euro USD is not as tight as in the daytime. Now at the cross of the along the video, I'll be explaining to you why it is so. Why it is so. Why now Euro USD is not as tight as when it will be in the daytime. Now let's move on. Well, we talk about how it is. Now I want us to understand something. Now major pairs such as the Euro USD and the USD JPY are mostly liquid due to their high trading volume. Trading volume is when people actually trade the pair. Are we together? When we have much people trading a pair, brings about what, trading volume, high trading volume. While exotic pairs such as that's minor pair such as USD chaff, USD and TRY, etc., they have less trading value. So the reason for them having a wider spread and a higher volatility. Are we together? They have wider spread and what, higher volatility. And then this matters because high liquidity reduces trading cost and ensures smoother execution, because it's crucial for scalpers and day traders. Now, low liquidity can increase cost and risks due to. Now let's move on. Now let me explain something. Look at Euro USD. Now if you go for a sell right now, it will take few move for you to be on profit. It will take few move for you to be on profit. But when you enter a pair such as USD MXN, you discover that it will take a longer time for you to enter profit, and with that you'll be frustrated and tired. And the wider the spread, the wider the okay the larger, the I'm looking for a best word to use now. Okay, we all know that when you enter a trade, the first thing that happens is that you will be on the loss, whether it is a buy or a sell. The first thing that happens is that you will be on a loss until the bid and the ask is above or below it completely before you will be on profit. Now with this kind of larger spread, before it will be on top your trade or below your trade, actually it will take a little time. That is why I said that the lower the liquidity, the increase the cost. The lower the liquidity, the increase the cost, which means the higher the liquidity, the lesser the cost. It will take you little time and little movement to start making profit on Euro USD compared to the USD MXN. Look at it. It will take you little time. That is the cost, the increased cost and and the lower cost. Now, having considered this, you discover that scalpers usually love tighter spread. Scalpers usually love tighter spread. Why? Because they don't stay long in the market. But you see, position traders and then swing traders can enter a pair that is not liquid and still don't worry. Why? Because they are not going to close it in that very day or in that moment. So they close it after some months, after some weeks. So they are not even concerned about that at all. But you see, scalpers and day traders, no, they need pair that is liquid for them to be able to trade the forex market. Now I want us to look quickly at the factors affecting forex liquidity. Like I told you that the spread in Euro USD is not as tight as it is in the afternoon as it is now that is evening, because I'm doing this video in the evening. I wanted doing this ever since, but I got busy. So and I promised my community that I am doing the video today, so I have to deliver to them the video today. Now, factors affecting forex liquidity. Now we have several factors affecting the forex liquidity. That's the forex the liquidness of the pair. Now I only itemize 4 factors, but we have several factors, but I only itemize 4 factors. Now what is the first one? The first one is that that of the trading hours. You see, that's the major thing, one of the major things, and that's what I told us. Now trading hours affect liquidity in a pair. Trading hours. Now when we are not in a major trading hour, there is always going to be low liquidity in the market. But when we are in major trading hours, you see high liquidity. When I talk about major trading hour, I'm talking about where the population of people trade the more and where the population of people trade less. That is what I'm talking about. Now, trading hours. Now, liquidity peak during overlap of major section has high what? High liquidity. Now, such as the London, New York time, and then also the Asian London time. Now, when trading activities is highest, quiet hours like the Asian section see lower what liquidity and wider spread. That is why we are seeing that the spread of USD, Euro USD is now what? Bigger. Why? Because we are now in the Asian section. We are in the Asian section. But if you look at the London section and the New York section, especially when there is overlap from the London sector to New York, you discover that the spread is very, very tight. Now, that alone is telling you that there is high liquidity in the market. There is high liquidity, there is high trading volume in the market. That is why the spread is very tight. The bid and the ask are very well tight. Why? Because we have high trading volume in the market. But you see, now we are in the Asia section. Look at what we're having. We are seeing little differences. We have the spread not as tight as it used to be now. That is the first factor affecting liquidity in the forex market. Now, the second factor is economic event. That's our fundamental analysis. Economic what? Event. Now, major announcements such as the interest rate decision, GDP report, etc., can cause liquidity to dry up temporarily. Note the word temporarily. Temporarily, as traders react, leading to volatility and wider world spread. Now, for example, the Bank of Japanese at 2024 rate hike caused significant volatility in USD JPY, especially the JPY pair. Now, this is actually what happened temporarily. Most times when there is news, spread tend to increase. Most times when there is news, spread tend to increase. The spread of the market tend to increase. Most times when there is news, put it at the back of your mind. Most times, look at this. This is a news. This is news. Most times when there is news, forex peers usually increase their peers usually increase their spread. Now, how can you check news? We all know one of the popular sites for us to check news is the Forex Factory. Now, Forex Factory. Now, when you enter Forex Factory, you're going to see news. See it, Forex Factory. Now, Forex Factory is one of the places we can see news. Now, today is August 28, which is Thursday, and the news for today are not major news. The news of today are not major news. Now, when it is major news, you see it red, because major news used to move the market. Now, look at it. You discover that we have minus, we have plus, which is a green, we have minus, which is a red, and then the ones that are stable are the white. So I'm not teaching us how we can actually read Forex Factory, but I'm just telling us that the economic calendar can actually affect liquidity in the market. Now, it can affect liquidity in the market. So let's move on. Now, currency pairs also. Now, major pairs are more liquid than minor or exotic pairs due to high trading volume. I have used Euro USD as example. Now, Euro USD alone account for over 1 trillion daily transaction. Now, Euro USD alone have people trading at least 1 trillion daily, exchanging business daily, 1 trillion daily on Euro USD. You see, that is why Euro USD is um, one of the liquid pairs that we have, one of the best and the strong liquid pair that we have. Now look at them. You discover major pairs. I just gave us example. Major pairs are the pairs that I usually trade. JPP, JPY are major pairs. JPP USD major pair. JPP AUD major pairs. Euro JPY major pair. Euro card, you see, major pair. You see the spread very tight. But when you come to exotic pair and minor pair, you see them, you discover that the spread is what is low. We have low liquidity. Look at it, low liquidity. We have low liquidity. So pairs actually what affect liquidity in the market. And lastly, market participation. Sorry, market participant. Now market participant also affect the liquidity of the market. Now liquidity is driven by central banks, not just one central bank. Now institutions, hedge funds, and retail traders, market makers ensure liquidity by providing constant buy and sell price. That is how market participation work to provide to affect liquidity, because when the central bank push in some money, it affects the market. When they remove some money, it affects the market, and that alone forms what we call liquidity pool. Because when there is a pool of money, of fund, the market go, and then when there is a removal of fund, the market also move. Now that is for that. The third thing I want to share with us is the liquidity zone and pool. Liquidity zone and pool. Now this means that there are areas in the trade, in our forex trade or forex chart, sorry, whereby you can clearly see liquidity zones and pool. Now these are actually locations and sites whereby we can actually watch out for us to enter a trade to make profit. Now you want to make profit, look for liquidity zone and pool. Now I'll be sharing with us how we can look out for this. Now liquidity zone are price level where large number of orders, that's stop losses, pending buy and sell orders, etc., are concentrated often at key support and resistance level around round numbers. You get it? Around, most times they are around what numbers. Now, or previous high or low. These zones attract price action because large players, which are institution, hedge fund, seek to fill orders with minimal market impact. That is why I always advise forex traders, make sure you understand these zones that we are talking about, liquidity zones and pools. Make sure you understand them, such as our area of demand and supply, because price always respect those areas of demand and supply. Now these zones attract price action because large players such as our hedge fund, our institutions, central bank always focus on such prices locations in order for them to release liquidity. Now, type of liquidity zone quickly. I will be giving us 6 to 7 types of liquidity zone. Now the first one is the Fibonacci zone. Now I have taught over and over on Fibonacci zone and Fibonacci expression, so that people will understand. Now Fibonacci is actually a name of a person, and the Fibonacci has different levels. It has different levels whereby price used to move around. Now let me go on 1 hour time frame and let me show you how to check this liquidity zone. Now I'm going to add and then Fibonacci time zone. Sorry. um Let me go to liquidity. Now Fibonacci retracement, sorry. Now look at it. You will discover this is how to add the liquidity, the Fibonacci zone. Now you discover that that aligns, there are lines, there are lines of this Fibonacci. We have the 0, we have the 100, we have the 61, we have the 50, we have the 38, we have the 23, we have the 0. Now these are actually lines that help us to locate liquidity zone. Now this Fibonacci derived from Fibonacci retracement level, which most times the levels are very important, is the 38 and also the 61. 38 and 61. Now this indicate potential reversal point. Most times when we draw these levels, there are levels whereby price most times usually reverse from those levels, especially the 61. In fact, the 61 work with the moving average 200. The 61 work with the moving average 200. Now this indicate potential reversal point. The Fibonacci zone indicate potential reversal point. Now the second is the psychological what zone. Now round numbers like the 1.2000 draws orders due to traders psychology. Now due to psychology, that's the mind of traders, you will discover that there are zones that actually have such kind of liquidity because of the mindset of traders, because of the mindset of traders. Now I'm trying to look at a round number also. I'm go to the day round number that has such kind of thing, because oh, I'll have to look for it backward. But just put it at the back of your mind that such kind of round number like 0.1000, 0.51900, now they are round numbers. They are round numbers, and those round numbers tend to be locations or area whereby liquidity can be provided. Liquidity can be provided, or it can be taken off. Now volume based zone, areas with high historical trading volume signal support and resistance. Areas with high historical trading volume signal support and resistance. Now you see there was a high trading volume here, high trading volume here, and it automatically becomes our area of what, of support. Automatically becomes area of support. Why? Because it is a place whereby there was high transaction volume. Now look at this, also automatically become area of support. Automatically become area of support because many trading volume was done at a level, now let's move ahead. A historical zone, sorry, volume based zone, sorry. Now area with high historical trading volume signal what? Support and resistance. Now historic zone, past price level with significant what? Activities. They are also what? Liquidity what? Zone. Now for example, this place that I drew is actually one of the high liquidity zone that we have. One of the liquidity zone that we actually have, because many activities was done, many activities was carried out, and it becomes a historical zone which contains past histories. Now we have the trend line based zone. Now areas around trend line where other blocks cluster, they are what? Trend line based zone. They are trend line based zone. Now the last one is actually the confluence zone. Now this confluence is actually very very important. Why? Because this confluence actually is what gives you confidence that your trade is going the right way. This confluence gives you confidence that your trade is going the right way. Now when we are talking about confluence zone, we're talking about where multiple indicators such as Fibonacci, moving averages, and our RSI, etc., overlaps, increasing liquidity. Now there are times that the overlaps, like the crossing of the 50 moving average above or below um the above or below the of 50 moving average above or below of that of the 200 moving average. You will discover that most times that area is the area of 61, Fibonacci 61, and then you can see clearly how that you will see a clear chart pattern, and then your RSI is actually giving you a divergence, and so now you're having many confluence in order for you to enter your market, to trade the market. Now I hope we are enjoying this training. Now the fourth thing I want to be teaching us is the liquidity sweep and graphs. Now I remember I did a video on liquidity word sweep. You can check the video also on liquidity sweep in this YouTube channel. Now liquidity sweep and grab are strategy used by institutional traders to exploit other word clusters. Now for example, when okay, let me finish up, then I come back. Now liquidity sweep, large players push price through key level to trigger stop losses or pending order, creating liquidity for their trade. For example, price may dip below a support or resistance to trigger all sell stop, then reverse as into institutions buy. Now liquidity grab, a rapid price move through a liquidity zone, often within one candlestick, followed by a quick reversal marked by a long wick. This signal signifies strong buying and selling pressure. Now let me show us this. Now for example, okay, let me use this as an example. Now we all know that let me see. Okay, look at this now. Look at this. Now this is actually a clear chart pattern, a very clear chart pattern, very clear chart pattern. See, it's a very clear chart pattern. Now this particular thing that happened here, is liquidity graphs. You see that they shifted below the normal pattern, and then it start moving the right way. Now, for them to do this particular thing is so that they can hit stop losses of people. So they can hit stop losses of people. Now, once they do that, they hit the stop loss of people, and then your trade will paraventure will be closed, or it will close once your stop loss is hit. That's why I always advise people not to use stop loss, but though at the beginning level it's good for them to actually understand how to use stop loss. But as they grow up, as they become very good, now stop loss is not mandatory. Stop loss is not mandatory. You can do without stop loss. Now just follow me, please. The liquidity sweep is when the market makers or the institution hit the stop loss of people and then begin to go the opposite direction within one candlestick. You can imagine like this one before it start going for a buy. Now this alone can actually trigger many trade and make people to actually lose their money. Many people, in fact those that don't watch and monitor their trade, you can imagine what happened here. You can imagine what happened here. You can see clearly for yourself. You can see clearly for yourself. Look at the one candlestick now has triggered as if it was going for a sell, but it was not going. So it triggers the stop loss of people, of traders. Retail traders now are being affected because it triggers their stop losses. Now, after it triggers it, it goes what? The opposite direction, which is for a buy. That is why you see I said I don't advise people to use stop losses until they are very good. Why? Because this is actually an area. Don't be surprised, it's an area of support. Now this can be a previous support. Let's see if I'm lying. Look at it. Let me draw it. You see that it is a previous support. Look at the place. So now traders, listed traders already know that price will reverse at this particular point. Look at it. Look at, you discover, look at, okay, you see it. Sorry, yes. So you can imagine this is it. You see it. You see the level. You see previous history too shows us. You see it. It's respecting a level. There's a level it is respecting. Now we need to understand this. Don't be in a haste. You need to understand. Watch to the end. Now we discovered the liquidity sweep and then liquidity grab. Now we have the trading strategy. Now identify liquidity zone, that's the buy side and the sell side, and watch for sweep graphs. Enter trade after a reversal confirmation with a stop loss beyond the wick and a ratio 2 to ratio 1 risk reward. Now if you want to enter this particular trade, let's go back to 1 hour time frame. If you want to enter such kind of okay, it's not even here, let me see. Okay, something like this. Let's just leave it as okay, like something like this. Now that it gave us a sell before going for a buy. You see this candlestick. Now after this candlestick, you need to wait in order for you to see confirmation, because once you see confirmation here, you see a pullback to test this level, this break even. This particular place is called the break even. The break even. Now, if price come and reverse back to confirm this break even, it means that this is actually a confirmed area whereby we have high liquidity. Now you see that it went forward for a buy. Why? Because this particular zone has high liquidity. It has high liquidity. Now, trading strategy leveraging what? Liquidity. Follow me, guys. Trading strategy leveraging what? Liquidity. Now, liquidity based trading focuses on aligning with institutional world behavior. That is why I always tell people that the trend is your market. Why? Because the trend is your friend. Sorry. Why? Because institution, bank, hedge, and big retail traders always focus on the trend. They always focus on the trend. Now, key strategies in order for us to follow the trend include the following, which I'll be giving unto us. I'll be giving 5 to us. Now, the first one is stop loss hunting. Now, institution push price to trigger what? Retail traders stop hunt at what? Obvious level. That's why it's not good for you to what? Put your stop loss on the same level whereby everybody is having. No, it's not right. Now, traders can avoid this trap by placing stop loss away from predictable what? Zone, or trading the reversal after a sweep. Are we together? Trading the reversal after a sweep is actually possible to trade the reversal after a sweep. Now, the second one is actually the breakout. Now, let me show us now stop loss. Stop loss, you see it after the week here. After the week, you put it after the week at this particular place or lesser. Then it will what? It will go. That is how we can do it in order for us to escape this issue. Okay, look at this. Look at this. Now, this was actually the level before it came, touched the level and went down. So just imagine you put your stop loss at this place or here. Definitely the trade will touch your stop loss and you start going up. But if you put it lower than this, the hunt will not hunt your stop loss. Why? Because that's an institution level. That's an institutional level. Now, that is for the the levels. That's for the stop hunt level, stop loss level. Sorry. Now we have the breakout and fake out trading. Breakout and fake out word trading. Now, many breakout are liquidity sweeps that reverse after triggering orders. Now, traders can fake breakout by entry after price reject a key level. Now we have the breakout and the fake out. Now the breakout is actually the breaking from a region, a breaking away from a region, while the fake out is actually a fake move which the market makers or the institutions are doing in order for them to get profit from the market. So they give they give what we call the fake out. It's not as if it is a true breakout, but it's a fake breakout. And so many people usually get confused because they don't understand the strategy that they ought to use in order to curtail this. And that is the reason why I am doing this video, so that I can be able to teach people how they can be able to trade without having this in their mind. So let's move on. We have the order flow and absorption. Order flow and absorption. Now, monitor how large orders are absorbed e.g. heavy selling absorbed when price dropping signal. Now, scalping with market depth, that scalpers use order block data to exploit the micro shift in liquidity for quick word profit. And then we are having the reversal at liquidity word pool. Now enter trade after price reject a liquidity word zone, confirm a candlestick word pattern or volume. Now these are actually what we should look out for when trading liquidity. We should look out for the market depth and also look out for liquidity pool in the market, because that is where the power lies, where the major thing lies. There are times that there won't be chart patterns, there will be candlestick formation. Just know that is actually still part of the strategy in leveraging liquidity. Now we have tools for identifying liquidity. Now don't worry, we are about to finish. We are just in point 6. Tools for identifying liquidity. Now, to trade liquidity effectively, use these tools. Number one is the order book. Now this shows buy and sell order at different price level, revealing liquidity word depth. Now use volume profile. Now this highlight price level with high trading activities, including liquidity zone. We have the footprint now chart. Now this display contract traded at each price, showing absorption or imbalance. And then second to last, we have the market profile, which identifies the area, the value area, and control the point based on time and volume. Time and volume. Then lastly, we are having the stop hunt mapping. Anticipate where retail stop hunt are placed to predict what the sweep. If you can understand where people are putting their stop hunt, which is immediately after an area of support or resistance, that's how they used to put. So you can imagine, you can now be able to know that stop hunt mapping can be a tool for identifying what liquidity. Now you put it after that. Now what are the advantages and disadvantages or the challenges of this? Now the advantage is that align with institutional behavior and improve what trade accuracy. I was saying that is the reason why I'm teaching us this. That is the reason why I'm teaching you, because I need our trade accuracy to be what increased. Now, enhance risk management by avoiding stop hunt. You see it when we don't, when your stop loss is not being wiped. It can only be hunted for, but cannot be wiped. You see that is actually an advantage. Now, it works across markets. It works across the market. That is the advantage. Now the disadvantage, which is challenges, is require mastering complex tools like order block. Now I will be teaching you order block. My next video will be on order blocks. My next video will be on order blocks, and I'll be teaching us how we can use order blocks. Now liquidity can be manipulated in less regulated market. And rapid liquidity shift demand quick decision making. You have to be active so that you take decision on time. Now practical tips for trading liquidity. We have trading during high liquidity hours. Like I told us, the trading hours, that's why I am actually a day trader. I don't trade at night, Asian section, because of the timing. So trade during high liquidity hours. Focus on London, New York section when they are overlapping. The spread will be and tighter and fast what execution. Use limit orders to prevent slippage by setting specific buy and sell what prices. Now, monitor economic calendar like I show us. We can use the Forex Factory for that. Monitor economic calendar. Avoid trading during major news because of the spread. During major news like the MPF, uh, NFP, sorry, like the FOMO, like the CPI, etc., etc. Avoid trading during news event. Stick to major pairs like the Euro USD, USD JPY, USD CAD, etc., etc., because they are what? They are liquid pairs. They are liquid pairs. Now, combined with other indicators, use liquidity zone with fair word value gaps. Liquidity zone. Now, other blocks for conference. Now, the last thing is that liquidity and risk management. Now, high liquidity reduce splittage and trading costs, but low liquidity increases risks. So how can we manage this now? Set up stop loss beyond liquidity zone to avoid sweep of your word um of your trade. Now use wider stop in low liquidity conditions. In liquidity what conditions. And then last but not the least, which I will explain to us, is our target profit. Our ratio for the target profit should be 2 to ratio 1 or 1 to ratio 2. Don't go for 3 to ratio 1 or 1 to ratio 3. What do I mean? Now for example, we are going for a buy and we started buying at this particular place. Let's say we started buying at this particular place. Now, on a normal sense, if we reach here, if we reach this particular place, it will be our first area of take profit. Then here, it will be our second area of take profit. Then the third one will be here. But I always advise, when you have reached the second ratio, you can close your trade. Don't wait until you reach the third ratio. Some people even have 5 ratio, 4 ratio, 6 ratio. No, once you have the second ratio, stick to your second ratio. Especially day traders like me, stick to your word, stick to your ratio, your 2 ratios. Don't trade and over trade. You want to make profit, please mind you, don't trade and over trade. Stick to the ratio, and then you will see that you will definitely make profit. Now, in summary of what I've said, now liquidity work with support and resistance. And then when you are trading it, you see this is actually the first side of, look at here, you discover that, look at here, this, look at what happened here. This is where this started, but when it wanted forming the structure to sell, it has to go backward here by touching people's stop losses, by touching. So for you to be wise enough, you give a little gap. Now this is actually area of resistance. That's area of demand. So take note of that, please. Take note of that. And also where you see after news, you see reversal. Now take note of that also, because it's actually proof of liquidity, also liquidity swept. Now I want us to understand something again, very in conclusion, that our trading hours matters a lot. In the forex market. Most times, I remember when I started trading, I used to trade in the night, but now I don't trade in the night again. Why? Because I understand that in the night, market does not move. It is liquidity that moves the market. It is liquidity that moves the market. It is only when the market moves that you are in profit. So only stick to when market move, and that is the New York and also the London section. That is where market moves. Stick to the timing. Stick to the timing. Don't be trading when market does not move, because there's tendency that you're going to meet high spread, and then definitely you are going to lose money. You're definitely going to lose money. Now, I want to stop here for today. I want to appreciate you for watching to the end. I know and I assure you that your time watching this video cannot be waste, because you have learned so much. Now, look forward to the next video, which will be the order blocks. I'll be teaching you on the order blocks, everything about the other blocks, from basics to the advanced about the other blocks. Thank you so much. Don't forget to share this video with your family and friends. Also, when if you have any comment, you have any question, you can drop it on the comment section, and I will reply you within a jiffy. I don't waste time to reply my community. I will reply you immediately if you have any question as regards your liquidity. Thank you so much once again. See you in the next video. Bye.